And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the pre-Friday Eve edition. Hard to believe another week has now passed us up. Half of the month now gone. It's August. It's just going by quick. So school starts next week. I don't know what that means because nobody's actually going back to school. But, you know, all I know is the wife made a run to Specs for the weekend. So teasing. You know, so back in the 90s, I lived in Spain for a couple of years while I was working, and because I actually lived all over Europe, but I spent about 2 years living in Spain, and it was interesting because everybody drinks in Spain all the time, right? You get up in the morning about 9 o'clock or so, you go have coffee with a little bit of alcohol in it, you have wine with lunch, you have a beer after your siesta, and then, of course, nobody eats dinner until like 10 or 11 o'clock at night, and of course, they're drinking with dinner. So I literally asked a guy one time, I said, so we're having dinner and we're talking. I said, so is alcoholism a big problem in Spain? He says, no, absolutely not. We don't have any alcoholism in Spain. I go, how do you know? I mean, do you have like a national day of not drinking and everybody gets the shakes?
What's the baseline?
Exactly. So I'm just curious, coming out of this whole quarantine, lockdown, kids in school, you know, the rise in, I mean, AA is probably going to be a good investment at some point down the road.
Our kids are all being taught by day drinkers.
Exactly. So anyway, kids are supposed to go back to school next week. We'll see how this all works out. You know, as we talked about before, though, there is an economic impact to that, as today more than ever we have two-income households. And that means that if a parent, for instance, you've got young children, say between, you know, the ages of, say, 5 and, say high school, where you can't really allow them to be latchkey kids and they can just come home and take care of themselves or whatever. A lot of parents are going to have to make the decision about whether or not one parent quits their job to stay home and take care of the kids. I mean, this is an economic impact that we haven't really talked about a whole lot yet, which is going to be the ramifications of keeping schools closed to the economy. There's always secondary events to all of these decisions that we make. Okay, great. I understand nobody wants to go back to school because everybody's concerned about getting the virus. But what's the secondary event from that? Secondary event is that you have people having to drop out of the labor force in order to stay home and take care of kids. So again, we have to really think about these economic impacts. There's a lot of expectation, and this is really kind of based into the price of the market as well, is that ultimately, you know, this is all going to come back to normal. Now that the pandemic is over, we're about to be all back to normal. That's what the market's telling you. The market's telling you, hey, V-shaped recovery, unemployment's going to go back to full employment. We're going to have just a return to economic prosperity just right around the corner. All this is good. That's what the market's telling you, and that's what the market's pricing in here. The question is really or not if that's going to be the case, right? That's the big question. Okay, but let's go through a few of the markets yesterday because we are sitting right here at all-time highs. Closed just a little bit shy of the actual all-time high yesterday. We're sitting right at it. We'll probably try to make another advance today. So again, as we talked about yesterday, we wrote about this in Tuesday's Technically Speaking report, putting 3750 as the next high target for the S&P. And the reason is simply that's the long-term bullish trend. That's where it gets you to over the next year or so if we can make these all-time highs. Now, this is not surprising here that the S&P 500 is at all-time highs currently because the NASDAQ is already at all-time highs, and because of the market capitalization weighting of the stocks that make up these indexes, it's dragging all the other indexes up with it. And there's this kind of traders kind of have this push now to get the S&P to all-time highs. The Dow right behind that. That's going to be another push here. Expect to see a rotation potentially into some of the more Dow-related type stocks, basic materials, industrials, financials. Look to see a rotation there. Those have been the big laggers to this point, and so start to look at seeing those try to get pulled up as well, as money says, well, I've already, chased Apple and Amazon and tech as far as I can. Let's find some stuff that hasn't caught up yet, and we'll have this rotational kind of catch-up trade in the market. So look for that occurrence here. And we're actually kind of seeing it in some other areas as well. If we take a look at international, big laggard to the overall market, but actually just breaking out here of this consolidation range we've been in. Got a very early buy signal here as well on both the MACD and the money flows. So we're starting to see that turn up here just a little bit, and that's starting to give a little bit better impression. We're getting a little bit of money movement outside of just kind of the big tech, starting to pull in some other names. We'll see a bit of a catch-up trade here as well. Likely going to add this to portfolios either tomorrow or next week. But again, seeing the 50 and the 200-day moving average cross here, also kind of bullish for international stocks as well. But again, just really kind of paying attention to the dollar. Dollar is trying to bottom here, turn up. It's been a very weak bottoming process here. We'll see if this can hold, but the buy signal is getting pretty extended here on the dollar. Gold continues to kind of give up the ghost as well. We had this big decline yesterday, another decline. The big decline day before yesterday, additional decline yesterday. Gold wants to come back down to around $1,710 an ounce, somewhere right around there. Again, sell signals across the board. So again, watch your gold exposure here. We talked about taking profits a couple of weeks ago, hedging that gold position with the dollar. That's all kind of working as we expected. Bonds also have come down to important support here at the 50-day moving average. So again, we had bonds kind of get really, really overbought, very stretched to the upside. Seeing that correction in the bond market, I think we're about to the bottom of that. Probably a good opportunity to start looking to add back to bond exposure here. The sell signal is very oversold here. So look for a turn up here. Look for some stabilization today and tomorrow. Look for money flows to head back towards bonds, potentially probably even next week. So those are just kind of the things that are happening in the overall markets right now. But again, the general sentiment of the market is to continue to kind of push things higher, and money flows are extremely extended into the big mega cap names right now and into the market itself. So again, it suggests that yes, we'll probably get to all-time highs. We may struggle there for a bit, but once we do that, the next question is going to be what happens over the next couple of months. So again, that's just kind of where we are. We're going to pick up with Michael Lebowitz here in just a second, talk a little bit more about this, kind of what's going on in the markets, kind of this detachment. This, as I was saying, you have this kind of big detachment between what the markets are expecting and what's actually happening in the economy. So we'll talk about that next with Michael Lebowitz. I'm your host, Lance Roberts, for today's edition of The Real Investment Show. RealInvestmentAdvice.com. Our latest blog posts are out. I've got a great one coming out tomorrow on bubbles. Talk about that one tomorrow. That'll be on the website, RealInvestmentAdvice.com. We'll be right back.
Writings on the wall, very superstitious. Let us back the ball.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Baby shark, baby shark, baby shark, baby shark, mommy shark, mommy shark, mommy shark, mommy shark, daddy shark.
And welcome back to the show this morning. It's 6:18 as we kind of get this pre-Friday Eve edition underway. Michael Lebowitz, CFA, joining us live from his bunker in Maryland. So
you like saying that, Tom.
I do. Pretty much, my goal is to build a compound somewhere in like North Carolina, up on a mountain somewhere. That's my ultimate goal. Don't come visit.
Unfortunately, I think there's a lot of popularity in that now, so you may have to pay up for that.
I know, probably true. So have you watched any of the baseball games here lately?
I watch an inning or two.
Yeah,
it's hard to watch. It's hard to watch.
It was interesting. I forget what team it was. I'll think of it here in a second. Maybe it's the Cardinals, but one of the players actually threw one of the game balls at the cardboard cutout. Just to
right. Yeah, I saw that.
Just to get into the spirit of things, right? And it is kind of odd though when you look at the stadiums and it's just all these cardboard cutouts everywhere. I still think they should turn this into a video game. If you like smack a homer and you hit somebody in the stand, you get like an extra point. So you might as well make it fun while you're doing this.
Right.
So, all right, couple of things to get to work here. We have been talking about here over the last couple weeks. Here it is, markets are hitting all-time highs. And as we were kind of talking about in the opening segment this morning, is that if you just look at the financial markets, right, just look at the S&P 500, and you assume that there's a linkage between the S&P 500 and the underlying corporations, obviously, and their corporate profits, and that's a function of what happens in the economy, right? So, in order for a company to make money, they have to sell a product, and that would suggest that they're selling a whole lot of product to the economy, et cetera. And so what the market's saying is that, hey, we've got a full V-shaped recovery in the economy. We're going to be back to where we were pre-pandemic, literally next quarter, so to speak. I mean, that's kind of what the market's telling you. But if we look at the economic data, it certainly doesn't look that way.
So the Fed's not buying stocks, right?
Right.
So you can make those comments because the market is, not directly manipulated by the Fed. But let's just look at the corporate bond market, right? Because that's supposed to tell, there are very similar signals in a corporate bond market. Mm-hmm. So let's look at what the corporate bond market is telling us, and then we can project it to the equity markets. According to the corporate bond markets, things have never been better for corporations financially, right? There was a big article in the Wall Street Journal about Ball Corporation, what are they? They're junk, right? Double B plus.
Yeah, junk rated. Yeah.
Junk, borrowing at 2 3/4. I actually emailed you, I forgot the corporation, but another corporation with junk bonds trading in the upper twos. Right. So the signal from the corporate bond market is both looking at absolute yield levels, so the 2 3/4 rate that we just said, or looking at the differential between those yields and risk-free U.S. Treasuries. If you were to just look at those, you would say the economy is going gangbusters and corporations are financially doing very well. Mm-hmm. Ergo, the bonds there's no risk to owning these bonds, right?
Right.
We know that's 100% false. 100% false. So, the same thing is going on in every other market, right? It's going on in the equity market. The Fed has our back. If the market drops 20, 30%, the Fed will come in and look, they bought junk bonds the last time. Why wouldn't they buy stocks? They now have, everyone will say, oh, it's illegal. They can't do it. Well, it was illegal to buy corporate bonds, to buy junk and corporate bonds.
And to buy ETFs.
And to buy ETFs. They have a platform. Right. Don't kid yourself.
Right.
And Congress will get behind them 100% in a crisis. They don't care who's president. They care more about their stocks and their promoters, right? So to speak.
Their sponsors, you mean?
Their sponsors. So what's going on in a corporate bond market is going on in the stock market, and it's going on in every market. And you can't look at these markets as a sign for anything. It's a sign for what the Fed wants those markets to be. And investors play along because they don't have a choice. Mm-hmm. They have to perform. Many of them are mandated, right? Many funds, like just look at these target funds. They're, a 2025 fund, say, has to be 70% equities, 30% bonds. They don't have a choice. They have to buy. And every week there's new money coming in. They have to buy stocks. And, this is passive versus active. And there's just forced buyers.
Well, and as I say, is that, it's and that's one of the problems. I guess it's not really a problem. It's just the way things are. And I think we just need to understand that because, the big conundrum is, the markets are going up, but I'm worried about these things economically. And again, if we take a look at the economic data, really kind of across the board, it's not great. And there's a lot of expectations for a very rapid recovery, but with the longer that we continue to fight rising, virus cases, have these mandates of, not getting together and keeping things shut down or at half capacity or partial capacity, that's just going to prolong the recovery. I mean, now we've got was it the governor of Wisconsin that's now mandating you wear a mask on a Zoom meeting? Yes. So because we don't want to spread the virus over a Zoom meeting, so we have to wear masks.
We're on Skype, so we're good, right?
Yeah, we're on Skype. It's apparently all sanitized, so it's good.
Okay,
just Zoom.
Good.
Yeah,
we have antivirus software on Skype.
Exactly.
Okay, good.
So, but this disconnect though is what has a lot of investors stumped. I mean, there's a lot of fundamental investors out there that are looking at the markets going, this doesn't make any sense whatsoever.
But can we take your statement one step?
But prices are what prices are, right? Go ahead.
Right. I just want to take your statement one step back. Let's just pretend there's a cure, a vaccine, and everyone gets it this afternoon.
Okay.
Everything is allowed to be wide open. You can go to football games. You can go to movies, hop on an airplane. You don't need masks. You don't need, just like it was back in January, right? Everything's back to normal. Well, the problem is it's not back to normal because economically we have damaged huge sectors of the economy that were debt-ridden before and now are more debt-ridden. We know that in economic we can't have a V-shaped recovery. It's going to be, best case scenario, some sort of, backward L with an upward facing the bottom part of the L.
Kind of a check mark.
Right. The Nike swish.
Yeah.
That's the reality of the situation. Now, we would like to believe that it's V-shaped, but it's not going to be V-shaped. And it's all been guaranteed by all the debt that's been put on the books. That's, as we say, I think every week we use the word unproductive.
Right.
Unproductive debt, which yields immediate benefits but no future benefits. And that's a huge problem. That's a huge problem because we have to pay that debt.
Yeah, we're going to talk about debt when we come back from the break here in just a second because we have to talk about the deficits and kind of new proposals that are being put out. So we'll get to that in a second. But just to wrap up this conversation about kind of where this disconnect between the markets and the economy, the important thing here is that the markets can remain detached from the economy much longer than people expect.
Sure.
And and what's interesting here is this is occurring at a time. There is some actual positive benefits from the shutdown from corporate standpoint, right? And there was there's concern about earnings recovery and earnings growth. The one thing that's happening right now for corporations, it's actually a positive, is that all these shutdowns are reducing expenses to a large degree. I mean, travel-related business expenses for companies have dropped sharply. I mean, nobody's traveling. Nobody's getting on a plane to travel somewhere. So, if there's a company that has a lot of outside sales, that's not happening. It's all happening on Zoom meetings now. And one of the interesting kickbacks from this is going to be what happens to commercial real estate as companies realize that they no longer need, entire buildings of office space anymore. And they can cut that expense. So there's going to be a benefit potentially to a lot of these companies, in terms of bottom line profitability because of the savings that they're picking up on and increases in productivity, et cetera, that are going to help benefit, their profits coming out of this recession. But there's a lot of other offsetting damage that'll occur, like I said, with commercial real estate is a good example, that's going to impede a lot of the progress of that recovery as well.
Right. And, one thing I've noticed, so I'm in Bethesda, Maryland, and there have always been 10 cranes in the sky for the last 3 years. Now the only cranes in the sky are those finishing buildings that were started before February. Who's going to start a new building anymore?
Right.
Like this whole construction boom that has hired a ton of construction workers, architects, you name it, to support the growth of those buildings are gone because it's really difficult to justify starting a new commercial or residential apartment building in a not even big downtown area, but an urbanish area.
Right. Yeah, exactly.
And those effects are just going to start to hit.
So, all right, when we come back from the break, I do want to talk a little bit about this debt because, there's a lot of proposals that are kind of going around right now about, funding on a variety of different things, right? And we'll talk about some of the more kind of oddball proposals that are being put through Congress. But the real question is going to ultimately become, the impact of, and again, as you and I were talking about, the impact of the debts and the deficits. We've got an election coming up. And, really, I'm wondering if during the debate process of this election, if anybody wants to actually address the debt and the deficit. Because, again, if you take a look at a lot of these proposals that are being put out for new programs and platforms and all this stuff, it's all driven by debt. So we'll come back. We'll talk about some of the specifics on debt, where we are right now, some of these proposals that are being put out, and, of course, what the real impact of this is going to be. Be right back after the break.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
Everybody get up!
And good morning and welcome to the show. It's 6:33 on this pre-Friday Eve edition. Half of the month already over. Can't believe it. School starts next week. Everybody's so excited. Yay. Kids are going nowhere. That's the real thing here. Hey, I need Mike. I can't hear him. Yep.
Speak.
There you are.
Test, one,
there you are.
two,
He was
three.
talking and I could see his mouth moving. You know.
That's his Marcel imitation.
I thought that was by design.
Well, no, it's either that or how do you know Mike's lying? His lips are moving. And nothing's coming out.
Right.
I'm joking. Okay, so a couple of things, though, just for the break, we were kind of talking about debts and deficits and these things. And again, this doesn't seem to be a concern right now at all for, any of Congress at this point. And we've talked about this kind of ad nauseum before, and I just think it's interesting because now we're heading into the election, and what we're going to hear during this election campaign is really more spending. Whether with Biden and Harris, they're going to be talking about all kinds of programs. There was an interesting article out this morning on CNBC, as an example, talking about there's now 142 congressmen behind the idea of reparations, and that could be as much as $12 trillion. If it kind of follows kind of the roadmap that they're discussing, that could be an additional $12 trillion. So we're already at $27 trillion ish here. By the time we get through another coronavirus relief package, whenever that occurs, and that's certainly going to occur at some point, it's just a function of time. But let's slap on another, say, $2 trillion on top of that. Slap on $12 trillion for reparations. Why not? Let's slap on another, $3 or $4 trillion for, whatever, other funding programs we want to do. But none of this is leading to productive investment. None of it's productive debt. And at some point, we already know there's a direct correlation between the amount of debt and deficits you have versus economic growth and economic prosperity. And not in a good way, by the way. That correlation is negative. But there doesn't seem to be really a concern at this point. It's kind of like just pretty much everybody's just kind of throwing up their hands and gone, you know what? Can't do anything about it. So I'm just going to get on the train with everybody else and let's just spend more money. That's easier.
Right. And I think the reason there's no concern is because there's been no inflation.
Right.
There's been less economic growth because of all the debt, but that's all pushed aside. Right. Mm-hmm. But now I feel like we're getting to the point where, okay, so what? 12 trillion in reparations. So what? We don't pay taxes anymore. So what? Let's just spend money on this, that, and the other. There's no big effect, right? Mm-hmm. That seems to be both Democrats and Republicans now are saying the same things.
Yeah, there's no fiscal conservatives left, right?
No, they're long gone.
Yeah.
So the question, everyone's thinking, why not spend it? It's free money. The Fed has this money tree. Let them pick the money tree. They'll basically fund it. And that's all well and good until tomorrow. Mm-hmm. And there's massive repercussions. And history is full of these stories that you can't just print money to prosperity.
Right.
And what we're doing is so damaging to our kids' futures. Well, and actually to our futures, not our kids' futures.
Yeah, and this is all stuff that's very short term in nature. And again, it's one of those things that you do it today, and so everybody feels good for the moment, but then they have to suffer the consequences longer term. And and look, let's just say that we're going to do, and then we've talked about this before, but let's just say let's give everybody in the country $1 million. Why not? Right? So there's 330 million people, man, woman, and child, and let's skip that. Let's just do households. So let's say there's about 190 million-ish households. Let's give everybody $1 million, right? It's only $19 trillion. So we double the national debt. Everybody's got $1 million. Problem is everybody will go out and spend $1 million. We'll have awesome economic growth. We'll have like 20% economic growth in year one. And then what are you going to do after that?
Right. After you buy your $200,000 little Ford or little Prius, right? Because that's what everything's going to cost. Right. Milk will be $30 a gallon. So you may have $1 million in the bank, but you're going to have to pay $80,000 in rent. And the numbers are all still going to be the same. It's just, it's all proportionate.
Right. Well, again, and it's the secondary effect consequence of this as well. So let's say that I give everybody $1 million. I'm liking this idea more and more, by the way.
Well, why not 2 million, Lance?
Sure.
Why $1 million?
I'm just picking round numbers. It could be 10, right? It's just math at this point. But here's what's interesting is let's say we give everybody $1 million, right? They all go out and they buy a $500,000 house. They go out and buy a $150,000 car, whatever. It's awesome. But next year they got to pay taxes on all that. Right, so you've got your property taxes, you've got your but their job has right. Well, but their job hasn't increased, their income hasn't increased, and again, we know that the monetary propensity of households is that I'm going to spend whatever I get. That's not going to increase long term, and this is the real issue: is that all this sounds great, but none of it increases long term economic prosperity. Go ahead.
Hey, Lance, after we both get our $1 million checks, though, we're not doing this show anymore, are we?
No, we're going to.
Why would we work?
No, because we're going to open up Robinhood accounts and trade American Airlines.
Right. There's no incentive to work anymore, right? If we're going to get checks, why be productive? Why do anything? Why not just sit by the pool all day?
Well, but that's the point, though. And then after the money's gone, which it will be very quickly, right? You haven't increased the long-term economic prosperity of the country. You haven't increased the long-term economic prosperity of households, but yet now you've got to service the debt.
Right.
And this is what eludes me is that, the people that there has got to be better people to elect for president and for vice president and for Congress than the people we have running the country right now. There's got to be smarter people out there in the world than this.
I told you who I voted for last election.
I know your mom has said she's not running this year.
No, she is, and she said you could be Treasury Secretary. Okay. I'll do something else.
Good old mom. Vote for mom.
Vote for Sheila.
But seriously, I mean, I know that everybody that's running for office, I get it, right? They have corporate sponsors. They've got to please the people that put them into office. I got all that. I understand it. There's just got to be a better way of doing this. And it would seem we've given up, we've completely given up trying to do a budget. Congress is supposed to actually operate under a budget. And maybe it's time we go back to the way it was originally founded in the Constitution. Prior to World War I, Congress had to vote on every single expenditure. So if you wanted to build a road, you had to vote on a bill for that road. If you wanted to go spend money for, building a bridge, you had to go vote on a bill for that bridge. Nothing else. It was every single expenditure had to be voted on. And then because of World War I and because of the requirement for expenditures were so rapid and so fast, they came into these bulk bills where we just voted on an entire bulk package. And that's really been the problem ever since. There's so many things buried in these bills, so much spending that are buried in these bills that they don't read or even know until after they vote on it. They go, what? I voted on that? I didn't even know that was in there. Maybe we need to go back to, I know it's a lot more work. Heaven forbid they get paid to work. But you have to vote on every bill. If you want to spend money on X, you got to vote for it.
And look, there's no repercussions either if the Fed's going to just give you money. Right? If you're a child and you go up to 7-Eleven and buy a bunch of candy, and instead of having to save money from cutting lawns all week, your dad says, here's another $20, have at it. There's no repercussion. Just do it again. Why not?
Well, the repercussion is everybody's getting poorer.
Exactly. Prosperity is fading.
Yeah. So, but again, and again, there doesn't seem to be at this point any way to reverse the process. Nobody's willing to make the changes necessary, right? Because to fix any of these issues, we've got to go through a debt reversion. Pretty much at some point, you've got to allow corporations to fail. You've got to allow households to fail. You've got to allow for the bankruptcy process to go through its things. The banks are going to, J.P. Morgan will be gone. Citigroup will be gone. Bank of America will be gone. They'll wind up going bust. Smaller banks will have to pick up the slack. But that's just the process of a debt reversion that you've got to go through. But once you go through that, you'll have an economic you'll have a real economic prosperity following that, but nobody wants to go through that painful process. So there's really no way to fix any of this. It's you and I are just talking for the sake of talking because we've got to fill 3 more minutes here on the show. But there's really no solution.
No.
You hate to throw up your hands and say it's hopeless, but it really kind of is.
Well, let me ask you a question, and I think this is important. Is it too late? Have we gone too far down this path that the near-term cost of fixing it is just too painful? Now, granted, no one wants to think about the long-term cost of fixing it because that's just as painful, but that's tomorrow, not today.
Well, but see, I've only got to get through 4 years, right? So if I'm president, all I got to do is survive my 4 years, and so I don't want to do anything in my 4-year period that gets me unelected. So it's 8 years, right? And these are long-term consequences. So I can keep running. As long as I can run debt during my administration and not pay the price for it, then the next guy gets to deal with it. And that's the general kind of attitude here.
Right, and it's the same in Congress. It's all of them. It's sadly all of them.
See, if I was in Congress, I would retire now. I would just say,
you know what? The rest of your life.
Exactly. You get paid the rest of your life. You have nothing to worry about, but you don't get the blame or whatever. Whenever this happens down the road, you don't want to be the guy in office.
Right. Exactly.
All right. Quick break. We'll wrap up the show. I'm Joe Lance Roberts. Be right back.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
So, there's an old saying, about standing in front of steamrollers to pick up pennies. The penny is actually making a comeback here on the news front, and a couple of different aspects. The first is that the penny actually costs more to manufacture today because of commodity prices than the actual penny's worth. So, for every penny we produce, we actually lose money. Millennials are now voting their concerns, I guess, or expressing their opinions would be a better way, is that they would just prefer to get rid of the penny altogether. Interestingly enough, on the other side of the ledger, there's now a national coin shortage that's going on because nobody's out circulating money, right? Everybody's at home, they're shopping online, using their credit cards, so nobody's out, circulating coinage. So because of that lack of circulation, there's now a coin shortage. And Chick-fil-A recently was even giving away a free chicken sandwich for coins. If you would bring in coins, I'm not sure that's actually free because you're giving them coins, but they'll give you a free sandwich if you bring your coins. But that's the problem, right? You can't get coins. But be careful now, because here's an interesting investment opportunity. I don't know if it's really an investment opportunity, but Kyle Bass is famous. He's a hedge fund manager who lives up in Dallas, and he was famous for hoarding nickels. And he had like hundreds of thousands of nickels that he had been kind of hoarding as an investment, believing that silver was going to go up. Now, it's important. You can't just get any nickel, right? You got to get a solid silver nickel, and that's what was important. Pennies between 1909 and 1982, I believe is the number, are actually worth more as scrap than they are worth depositing because of the amount of copper that's still in the penny. Now, today when we manufacture pennies, it's primarily zinc and magnesium. There's very little copper actually in the penny. But between 1909 and 1982, they were primarily made out of copper. So from a scrap basis, pennies are actually worth more than a penny on scrap. Now, that doesn't really solve if you're going to go scrap all your pennies, it doesn't really going to help our coin shortage much. But it's kind of an interesting conundrum that, we're kind of getting ourselves into. From that aspect, right, Mike? I mean, we've got a coin shortage because nobody's circulating any coinage, but now you've got money supply going through the roof. Right. It's interesting.
Right. Here's the other problem with that investment thesis of yours, that it's illegal to deface money. So yes, Kyle Bass may have each nickel he has may be worth a dime, but he can never convert it to that metal itself, or he goes to jail.
Right. So did you just pull a Yogi Bear out that a dime ain't worth a nickel anymore?
I think so. I think I did. Brent, did you get that?
Yeah, we got it on tape.
A dime ain't worth a nickel.
Yeah, but no, it's yeah, yeah. I'm not saying it's actually an investment thesis here and run out and scrap.
But a nickel is worth a dime.
Exactly. But yeah, I mean, it is kind of interesting though. The issue of coinage and the printing of currency and currency in circulation, et cetera, has been an interesting topic here for a while, because when you take a look at what's called M2, this is the money supply indicator, right? How much money do we have in circulation? And that's because the Fed has been injecting a lot of digital currency into the system, which is inflating M2. But there's actually a huge decline in the amount of money in circulation because we're not moving money through the economy. People aren't actually borrowing and expending dollars at the same rate they were before, which is why we have, 30% negative economic growth. So we have this big collapse in monetary velocity. At the same time, you've got this huge spike in money in circulation, but it's all being bottled up at the banks.
Right. So here's a good analogy. Let's say the Fed says today they're going to print $500 trillion and they're going to put it out on the front yard of the Federal Reserve. Well, as soon as they do that, there's a huge pile of money on the Federal Reserve, but no one takes it. It just sits there, right? It does nothing to the economy. It does nothing to inflation. It has no economic effect. Now the Fed says, okay, have at it. And everyone comes in and grabs money and they spend it. Then the money starts getting spent through the system. Then you get the economic benefits. You get the inflationary disbenefits. You get all the pros and cons of printing money.
Right.
So that's really what's going on, Lance. They're printing a lot of money, called reserves, called digital, call whatever you want. They're printing a lot of money, but we're not spending it. We're not using it a lot, which tells you a lot of it's going towards speculation.
Right.
That the markets are using it. Right. We're seeing plenty of inflation in not just the stock market, in the bond markets, and all kinds of, precious metals markets. Right.
Yep.
Everywhere.
Yeah. I mean, we've had, that's kind of an interesting thing too, because you take a look at, what's happening economically in terms of, activity that's going on. And you take a look at commodities, and, commodities are making a huge run here, but it's, commodities like copper, nickel, those should be more reflective of economic activity. And if you just pulled a chart of copper out, looked at and without knowing anything else, and took a look at a chart of copper as an example, you go, man, U.S. economy must be just booming, right? There's just they must be growing at 5 or 6% annually right now.
Lumber too. Lumber is going crazy.
Same way. But a lot of that has to do with again, this, money's chasing money at this point, and once there starts to be a momentum in the market, money just starts chasing it, and it doesn't. And again, this is why there's such I think this is why a lot of, people have this real kind of conundrum between this disconnect between the actual economy and the markets. And there was, a lot of articles written recently. The stock market's not the economy. Yes, it is. Ultimately, it is, because what drives earnings and profitability for companies is economic activity. And so either all of our economic data is terribly wrong, and we really don't have 50 million people unemployed, and we really aren't clipping off 1 million people a week in jobless claims, or something else isn't right.
Right. And there's enough economic data to know that there are real problems, right?
Yeah.
Right. So, I mean, you can look at corporate earnings. You can look at, there's many other sources outside of the government of economic data, and they're all telling you, look, we're in a recession. Maybe a depression. Who knows what we're in? And it's global. It's every country. It's not just our country.
Yeah, it's interesting, Mike, talking about earnings. Over the last, 3-4 weeks, there's been a lot of people talking about the uptick in earnings, right? Earnings expectations are ticking up. And you look at a chart, and it's a very small little uptick, but they did improve. So I pull earnings regularly from S&P 500, which gives estimates out till 2021. And they actually did. In the last 2 weeks of July, those estimates actually did tick up. And I'm scratching my head a little bit here going, hey, these estimates are ticking up. I pulled it yesterday through the 7th of August. All those upticks have now gone away. and they've reverted back down again as we're starting to try to reassess. And I suspect that we're going to see earnings estimates decline more here over the next few months as we head into the third quarter earnings reports. As we get into those, I think we'll see those estimates come back down again. But we're down into the $88 for third quarter earnings now for stocks. That's a huge drop from where we were at, and this is reported earnings, not operating. But we're down from $139 in earnings, but yet stock prices are at all-time highs.
So right. So when we're basically the same stock prices we're at today with $88 earnings as we were with $139 earnings.
Yeah.
Right. That's what you're saying.
Exactly.
So investors, you're getting a lot less for more.
Yeah, exactly.
You're paying dimes to get nickels.
I was trying to figure out how you was going to get that back in there.
I beat you to it.
So, all right. Well, real quick here before we wrap up the show. I didn't get a chance to talk to you about this yet. Joe Biden picked Kamala Harris as his VP. We had actually, you and I have had this kind of running bet going on for some time that would be his pick, and that turned out to be the case. This is going to be an interesting kind of election that's coming up between, Donald Trump and Mike Pence versus Joe Biden and Kamala Harris. I mean, this is probably one of the most diametrically opposed races that we'll have seen in quite some time in terms of vision and outlook and, platforms, et cetera. I think this is going to be a real interesting take about really the division that's now exists in the country is now moved to the national platform.
And I think what's interesting, it'll be the least televised, right? There's going to be, the debates will be minimal. It seems like there aren't going to be campaign speeches like there used to be. There aren't going to be, I mean, just the exposure that both candidates are going to get is going to be much less in front of people than we've seen in the last, 20 years. Right. So it's interesting. It's diametrically opposed views, and a lot of people really care about this election, yet we're not going to see it. We're going to see a lot less of the campaign itself.
Well, I think a lot of people are just worried that Joe might forget to show up for the debates. That might be the real issue. But, one thing that people have talked about, there was an article out this morning on I think it was on Market Watch, maybe yesterday late, that, has brought up this idea again that, Joe Biden is actually kind of a straw man for the election, and that after the election, if he wins, that he won't actually be president that long, and that he'll step down for, mental health reasons or whatever it is, and Kamala will take over as president. So that's kind of an interesting, and that's even picked up into mainstream media now.
Well, the running joke is we're still waiting to see who Kamala Harris is going to pick as her running mate.
Hillary Clinton. So she's coming back, I'm telling you. Yeah, no, I think, I do. I think this is going to be a really interesting. There's going to be a lot of things that are going to be really interesting about this election. And here's a prediction: is that Joe Biden is going to win the popular vote. He is going to lose the presidency under the Electoral College, and Trump will win the Electoral College again. Now, the reason I say that is that this is what happened in the last election, and we saw the turmoil that came out of that, and there was a rising demand, and even some states have now talked about the potential of getting rid of the Electoral College vote. But this could theoretically, there's something to think about, this could theoretically be the last election that we see run under the terms of the Constitution between a popular vote and Electoral College, which is what a republic, which is what the United States is built on, is giving the states fair representation in every election because of the disparity between populations and states. That's what the Electoral College solves. But the outcome of this election could change that going forward.
Can I give my quick prediction?
Very fast.
Whoever wins is going to spend a whole lot of money.
That's a
winner.
That's a winner.
That one.
That's a winner. It's a guaranteed. All right, got to wrap up the show for today. I'm your host, Lance Roberts. Get by the website, realinvestmentadvice.com. That's realinvestmentadvice.com. Also, check out our subscription website, riapro.net. Got lots of great stuff there for you as well to manage your own money. Realinvestmentadvice.com. Stick around, though. Chris Salcedo's coming right up.
It's a rich man's world.